Here we are. What's going on, everyone? I hope you're well. Listen, I just want to get together. Things have been seemingly escalating pretty quickly, and it's time we sit down. I know that we've been talking about these being unprecedented times for some time now throughout 2023, specifically since the spring. And right now we're at a juncture where things could either have escalated to the point where we're going to see actually, them simmer down a little bit, or from here, things could continue to escalate much quicker. So we just want to get together. We want to make sure that we have our bearings around them, around what's happening around us. And we're going to start off today's session looking at this chart over here, and it's a chart in red. And in red, you're looking at ultra long duration US Treasury bonds. This is something 25 years and beyond. And the loss from the peak to the trough is exceeding the stock market crash during the 2008 great financial crisis. That was about a 55% drawdown during the great financial crisis on stocks on the S&P 500. You are now looking at US Treasuries long duration exceeding that loss. Today, a lot of people are obviously focused on what's happening here across the markets, specifically watching yields. And do you remember when we were watching this descending channel? And why I was hoping and didn't think we were going to break out to the upside. Once we did, we were not only aware of it, we spoke about what do you think this is, what type of ramifications is this going to have across risk markets? Since then, as we have seen an acceleration, a lot of people, well, it seems like everyone now is obviously talking about it, and for good reason. I feel like in the last 24 hours, a lot has happened. In so much last night, I was trying to put my thoughts together, looking at the macro. What do we think is going to happen next? I know that we have done a good job navigating these markets and for a long time doing our best to stay on the right side. And I had this intuition that we are reaching a bit of a critical juncture. And last night I proposed I'm going to go ahead and try to share those thoughts and form those thoughts. And that's why we are here today to continue doing that. But it seems that everyone else is on the same page as myself now. So we're just going to review it. We're going to talk about it. We're going to go slow. There's no question the BOJ intervention is playing a role in all that. We got it keyed up. We got it lined up. We're going to just follow the flow here though and start off with equity markets here. And equity markets are selling off hard on this morning's JOLTS numbers. And, so this trend line we've been watching, by the way, because here's the thing, as we look at what's taking place right now, and I think that you could all kind of sense from my tone that I don't want to say that I'm worried. I'm obviously not worried, but I do believe that I think the title of this video is Approaching the Event Horizon, right? And that is keyed off a tweet this morning. Dylan, approaching the event horizon, global yield control, right? And, obviously that would be the most bullish case for Bitcoin imaginable if something like that were to happen or occur. And I don't think that when we talk about approaching the event horizon, I mean, we would not be having these conversations. I was going to say a year ago, but probably even less than that. And today we need to. One of the things that you all know that I've been lining up is the potential Treasury yield control curve next year. And is it just going to be? I don't think about that in a global sense, right? But it is a global. We're going to have to take a look at it all. We're going to go slow today. We're going to make sure we take everything in. I'm going to start over here with the US dollar. US dollar has tagged now 107 on the DXY. We've been able to stay on the right side of this. Don't forget, a lot of people were very bearish on the dollar. We were watching the breakdown ourselves, but it was quickly invalidated. Technical analysis trumps everything. because regardless of how you're able to, let's say, intellectualize the markets, and you could have a really firm grasp on the macro, markets can remain irrational and act irrational. So this is where TA is just simply an iron sword, helping you cut through everything and make sure, regardless of what your own personal beliefs are, in much the same way we are able to deploy a mechanical system for trading the markets, TA helps you stay on the right side. We were able then on the breakout over here to say, all right, well, regardless, we're here and we're bullish on the DXY. And now that has accelerated quite hard. It's reached our first target. Our next target is somewhere around 108, right? And it appears that we are getting ready. These lines over here, some people are like, oh, there's like a gazillion lines on the chart. So first of all, we pay attention to the bolder ones, the color ones, right? The lines that are intersecting, that are going back 20 years, right? All the way to the great financial crisis. For whatever reason, on this linear chart, and I know looking at a chart of this type of magnitude of time, that people would almost insist you have to look at a log, and that's fine. We normally are, but here the linear structure has just been the structure of the market. You could see over here, like if you remember what was happening into and the first sell impulse, by the way, was July. That one was faded, and then into the fall, why people were expecting enormously stronger dollar. We did take note of it tagging this line of resistance, and then the second sell impulse was a major trend change that we were in front of once again. And you know what? A lot of people, again, very bearish, and we were on the right side at the time, but we had to flip. And where we are right now, we're going to find out. We could see over here as the dollar gets ready to break much higher, we do see a little bit of a wick forming over here. And that wick forming, obviously, because we see the Bank of Japan with intervention today. So we're going to build into that. So we're going to, again, this would be the lower trend line over here. That would be a sell impulse that's taking effect in the market. But I bolded this line below. I bolded this line because I think that price needs to trade under that in order for this move that we're seeing on the dollar to be invalidated. So we are giving it room. And I just wanted, this is appropriate to talk about two things, I suppose, over here. The next one's going to be on oil. And the dollar and the oil and yields are the three themes that everyone is obviously watching over here. This is Tom Luongo. He runs a podcast. It's called Guns, Goats, and Gold. And over the last few months, I've become a regular listener. I enjoy it, and I enjoy it just because it offers a different geopolitical insight that I'm not able to absorb anywhere else. So I do enjoy it. And yeah, we're definitely going to be looking at the yen. It's already keyed up over here. Let's see where it is. We're going to be getting to the yen over here, and you can see that. Well, we're going to get to it. We're going to get to it all. So look, a lot of the focus right now is on the Bank of Japan, and potentially a major policy shift in the months ahead will be coming from them. They might abandon yield control curve. We're going to be watching for that. What type of ramifications would that have across the markets? Now, I just want to throw out there because, things are definitely at a point, again, where from here they could accelerate much further, or we could see a bit of like this was the top. Once everyone started paying attention, which is today, and I'm saying this only because it's true. We were very early on the breakout. We took the breakout. We had to take a sell impulse, exiting that over here, and then finally on the second breakout, to this day, being able to hold this trade. The yellow line over here is stop loss. The green line below, that's a sell impulse over here. This is a double black diamond over here. I think it's time we move up the stop loss, but we have a lot of room over here, and we're just going to give this trade room right now. It deserves room. There is obviously a big shift that is taking place in the markets. We've seen it, and we were as early as can be on the dollar, on the yields, and on oil. And these these trades are still playing out. It's too soon to be looking for any type of shift. So I have this feeling as we get, while we're at this particular juncture, that potentially we could be looking at things escalating further. The thing is I don't know, and you've often heard me mention, right? It could be Japan, it could be the European Union, and I think right now, rightfully so, there's a large focus on Japan, but we can't lose sight of what's happening over in Europe as well. And when you look for, is something going to break? And if you remember, I have to laugh when you go back to the spring of 2022 when all the podcasters were looking for something as the Fed began raising rates for something to break like imminently. We were like, no, there's like an excessive amount of liquidity out there. These things take much longer to play out than people believe. Nothing's breaking anytime soon. And today, all you hear out, oh, there's excess liquidity out there. And now today I'm like, well, that liquidity is being drained. And I know we often focused what's going on here in the US. By the way, the Treasury again today announcing another $220 billion of new issuances. This continues to put pressure here on the yields as we watch the yields. I'm trying to look for the yields over here. As we continue to watch yields rise, right? There's an enormous amount of supply being put on the market. It's causing yields to rise. And our hypothesis, right, when the Treasury announced, listen, we're going to be raising $1.85 trillion by the end of the year in the next 6 months. At the time, there was $1.85 trillion left in the reverse repo. Remember after they came to the debt ceiling deal over the summer, and then the Treasury had to raise money right away. And we said, listen, if this money comes from the money that's parked overnight in the reverse repo, it's net neutral for liquidity, right? Because it's liquidity being moved from one place of a market to another. It's not being like, it's not a demand on the market that has to come from somewhere else, because we're watching quantitative tightening run, right? That's obviously also a continued drain on the market. This could be a potential double whammy. And that money was first raised from over here. And then when they said, okay, we're going to raise another 1.85 trillion, I said, there happens to be that much in the reverse repo. Let's watch if it comes from here. It continues to see or appear that it is coming from here. And by the end of the year, they are expected to be done. We are going to watch where, if this money continues to come from reverse repo, and at the end of the year, where we are. Once reverse repo is drained, at that point, I feel like, well, then the clock starts ticking to where something systematically could break within the US. Now, trying to time that is almost impossible, and it's very difficult. And that's just one thing that we need to be aware of and watch. Another thing that obviously we're watching, or the two other things is, or three other things. From afar, we're watching what's happening in China. By the way, China has been stimulating through their reverse repo market. And since 2020, they have added the most liquidity. I meant to pull that up today. I don't think I have it up here right now, so we'll not look at that to tomorrow. Point being, though, is it doesn't mean something's going to break in the US. And the consistency that we have offered is we have to watch what's happening in Japan. We have to watch what's happening in Europe. That's going to bring us back over to here. This is a dollar event of the type that perma bears simply do not want to admit is possible. I mean, the truth is most people, especially with like the resurgence of the BRICS, and even though that takes a lot of time, and for sure, I remember in 2018, 2019, people would not even entertain the conversation that de-dollarization was taking place. Today, people are just expecting it to happen at a lot faster rate and pace than is, even though for sure it's happening. But here's the thing. It's likely happening because that is what the powers that be want to happen. It was probably too much of a burden for the US because of Triffin's dilemma to be able to continue to run these deficits that are needed if you are the world reserve currency. I think that is why they have accelerated the push. How did they do that? Well, you see, when they went ahead and they confiscated the central banks of Russia's reserves, both dollars and euros, that kind of accelerated things. They had already been accelerating through sanctions and whatnot. So, whether or not you are bearish or bullish on the dollar, and I am neither. I try to stay on the right side of the trade and trade what is happening. By the way, overall, since 2020, since we've been here together, we have done a really good job navigating that, all the way starting over here on the first breakdown in May of 2020. So, don't take a bias, form thoughts, but always, also in the title of today's video is unprecedented times. And that's something that should humble you, because you could say that no one alive has been in the situation that we are in today. And I think that if you're approaching markets and you have a respect for markets, and if you've been around them long enough, you should have a more than a healthy respect for markets. The best way that you could approach them is with just a strong degree of humility. And then when you're talking, or someone that's been in them for a while is telling you, guess what? These are unprecedented times. To think that you know with a degree of certainty what's going to happen is just something that, well, anyway. Lagarde is trashing the euro to save the German Bund, the German bond market. German debt basically flat over Friday's close. US 10-year off 8 basis points. The cost is nearly 1 cent on the euro. So again, this is just to highlight over here what we're seeing happen on the dollar. That is not just related to the Bank of Japan, also related to what is going on in Europe, and also related to what is going on in their bond markets. I want to move forward over here as we continue to talk about oil, because we talk about the big three pressuring the market. We talk about, you look almost every day, you see the dollar up, you see yields up, and you see oil up, right? Luke Groman adding his belief and insight, the beatings in duration on yields will continue into the US dollar, and oil are weakened meaningfully. And by the way, as you've seen recently on oil, we came in quick and sharp after breaking above the $85 resistance. Do you remember back over here in July, no one was talking about oil. We put out, that's a trend shift in oil. That looks like a rounding bottom. If oil gets above $85, then it begins having ramifications specifically for inflation. What is the Fed going to do? And we've come to a point where I continue to ask that question, because not this month of October, but next month CPI is going to show that resurgence of inflation. What is the Fed's response going to be? Are they going to be continuing to take rates higher? If they take rates higher, it's like the dominoes keep on falling. By the way, the clock is ticking. The clock is ticking to what? We talked about, listen, event horizon, global yield control curve. That would be the most bullish case for Bitcoin. And then Dylan bringing up, look, if you thought what happened in March when the Fed was able to take collateral, T-bills, off of these regional banks' balance sheet, remember that? We saw it in March, Fed balance sheet went up. Do you remember the same time that the Fed's balance sheet went up, that the next day that I said, well, quantitative tightening is still running. Watch what's going to happen from here, because you're going to see the balance sheet go down, right? And then here's that one up over here. And since then, we continue to go down. Now, in March, 12 months from now, that loan is up. What happens? Yields are significantly higher than they were back then. If it was too much for those banks to take at that particular time, that the Fed thought it was too much, that they needed to go ahead and extend out some extraordinary circumstances and take that collateral and put it on their balance sheet, what happens in 12 months? Like things seem to be accelerating. Dilling pointing out though, that's nothing compared to when we get to the commercial banks. We're all aware, by the way, that might be a slow motion snowball that might take years to play out. A lot of people continue to look at the commercial real estate market also, and they're like, look, this looks absolutely horrific. Why is no one really paying attention to it? It probably until I'm going to say 3-4 years from now, that's not really going to become an issue. And at that point in time, well, fun times. No, so I mean, I'm just going to veer off for 1 second. Am I paying attention to how China is making themselves sanction proof if they invade Taiwan? No, I have not been. That's not something that I have an eye on, and I'm trying to give you a resource of someone who would be the perfect person if you are interested in knowing or following that or asking questions. And it's my friend Thadia Kuzno. I would pull up and give you his Twitter, but anyway, if you leave a comment below on this video, I'll get you into that resource. He's who I would deem to be the most appropriate person to ask that type of question. Look, China right now is in no place, obviously, to invade Taiwan. The timeline on that, I do believe, is towards the end of the decade, if it is going to happen. But that is a little bit off topic, but good question. Just not my forte whatsoever. Let's jump back over and continue over here and build back in. And when I said that yesterday, I was thinking of hey, things seem to be accelerating. And again, that could be a particular point in time where we've reached kind of a peak and things cool off where they could really begin to accelerate. Since then, we have seen today the Bank of Japan go ahead and intervene. We'll look at that in 1 second. I'm not sure, have you seen this clip or not from Rick Santelli? And he's talking about how the 10-year could reach 13%. Now, he's talking throughout the end of this decade. He's not, by the way, you have over here, this is almost too funny to be true. You have, putting in the top, but obviously there's a lot of people. So this is a good place to talk about people here that have been long bonds throughout all of this. When I say throughout all of this, again, we are now looking at 60% drawdown in long duration bonds. That trade continues to be very, very crowded with people doubling down. I know it seems like we're extended on the move, right? When I say extended on the move, I'm jumping up and looking at as the 10-year out of the descending channel has skyrocketed. But there are a lot of people who continue double down and are already positioned wrongly on this trade. So we're going to continue to give it a little bit of room and see what happens on it. Did anyone watch this clip? Because if not, I am going to play it. I think it's something that everyone should be aware of because he's not being sensational. He's not talking about this is going to unfold today or tomorrow. He's talking about, over the next 6 years. And we have been talking about how we are in this new regime. And as monetary reset is happening, that we are likely going to be looking at much higher yields throughout this decade. Well, Zayton, let's go ahead and just watch at least a few minutes of it together. That way, if there's anything to comment on, we'll comment. And from there, we'll take a look at the Bank of Japan intervention. This is like almost all happening at the same time. We saw recently the Bank of International Settlements coming out and them talking about, let's start here.
Turn the spotlight on banks' vulnerability to higher interest rates. US, European, and Japanese banks saw their equity prices plunge as a result. In contrast, the equity prices of banks in emerging market economies, or EMEs, shown in yellow, held up well. This was a sign of investors' confidence in EME banks' management of interest rate risk. So how do they manage this risk? On the asset side, a large share of their loans have floating rates or short-term maturities. On the liability side, EME banks rely heavily on time deposits. As a result, interest rates on their loans and deposits.
I'm sorry, it's too dry for my taste right now. We're going to get into a little bit more of Rick, which is probably a little bit more exciting. But listen, so yields are rising because the Fed is collapsing M2 money supply for the first time since the Great Depression. There simply aren't enough dollars to cover debt issuance anymore. And then you have the US Treasury, right? The US Treasury is putting together a war chest, $1.85 trillion in a 6-month period. They are pulling what is liquidity that has been parked on the sidelines in the reverse repo. They're pulling it away from the market. They're absorbing it. That seems like a war chest to me. Are they preparing for war? What kind of war, right? This will lead to a massive insolvency crisis, fully engineered by the Federal Reserve. And now you have the BIS, the Bank of International Settlements, putting out multiple videos this week on the banking system's use of interest rates and derivatives and liquidity risks. We're seeing at the same time Bank of Japan under pressure. We're seeing also German bonds. Like, it's Germany. Everyone is looking at Italy, and they're trading at the same price as the German bonds, right? So what we're seeing here is an escalation taking place. Let's look at what Rick has to say before we look at what's going on over here with the Bank of Japan, what that means, and potentially what happens next.
I personally always find anniversary dates very key, and I can't help thinking about September of '81 when we had the all-time high closing yield just shy of 16%. So what I'm talking about here might be dancing between the raindrops. You never want to go against a market that is burning to the upside, but you might want to give it a pause if it looks like it's going to back away a bit. But in the grand scheme of things, I think rates are going higher. So let's go to the charts. Like I said, not my best.
So first of all, very balanced. He's saying, listen, you might want to back off right now as things have accelerated, and we continue to give it room. We said, listen, Luke pointing out the double black diamond recently. We have over here, this is the trend line break. And we said, if we see any type of exhaustion, like a sharp move up, that would say to us, that might be a time for us to go ahead and take profit. And this trade continues to extend out very far, very far. So, we might back off, but at the same time, you don't know, if things start getting a little dicey, they could get a little dicey, which is why we're giving it room. But he's talking about rates going much higher over time. He's not being sensational whatsoever.
But high-low perpendicular midpoint, we always pay attention to those, especially when one of those points is the all-time low closing yield at 0.5%. So you take the high, you take the low, you connect it, you find that midpoint, you draw a perpendicular line. And what you find is it just keeps you on the straight and narrow. Those are very key. The more important the spike levels are, whether it's a key high or key bottom, those make it work that much better. Now, this chart is really off scale. Remember, when you're doing these charts, you got to use logarithmic paper. This is just a rough gauge, but there's your near 16%, SEP 81 for your anniversary date. And the whole point of this chart is that we have a lot of potential room to run to the upside. So if somebody asked me and held a gun to my head and said, listen, the worst case scenario, where Treasury rate's going to go 10-year, I'd say in the next 7 years, you should be able to see 13.5%, 14%. Yes. Now, I'm not saying we get there, but I really want to stress you do not want to jump in front of this right now. But if this week closes under 4 3/4 and the high yield close remains in the 460s, you buy the market looking for a bit of a retracement to potentially get back down to 4 1/4 to 432. Or if it gets to 4 3/4 on a closing basis first, you liquidate the trade.
So you buy.
Well, I want to see the level he was looking at. He said 4 3/4. So but the level that Rick just gave about, like, look, he's saying don't chase here, and we're like, no, we lined this up over here. We back and forth and have been holding since here, right? He's saying if this level breaks 4 3/4. Right? That's 475. No, he's not talking all the way up there. At least he's given a place where this trade is time to exit it and liquidate the trade. We have ours. We have our stop right now, locked in profits all the way here, just above 4%. We could move this up right now here today, but we got room and moving to the upside. We'll probably be doing that in the sessions ahead. Point being is that Rick here is just giving his thoughts, which, by the way, I'm sure the vast majority of people that have been involved in the market, specifically during the last 40 years, where it's been nothing but this deflationary regime during globalization, are just not ready to accept or take serious whatsoever. Now, we're about to see massive debasement take place. Now, something that could really help that not materialize, by the way, and something that we're looking forward to as soon as next year could be that, the U.S. Treasury is beginning their buyback program. Is that why they've been building a war chest? Does the U.S. Treasury think that the most liquid market in the world, U.S. Treasuries, are not that liquid, and that they need to make sure that they are going to be there? Right now, they're saying it'll be on a quarterly basis, that they'll be there to make sure, if need to be, to provide that extra liquidity, buying the T-bills themselves. Now, that could easily, if yields remain elevated, turn into some type of yield control curve. I can't even believe, for me, that was not something that was even on the horizon just a year ago. And now we are looking at the very much probable scenario where the U.S. undergoes it. Dylan was talking about global. We are seeing right now the Bank of Japan continuing their yield control. The moment of fear. So you have over here on this chart, this is the last intervention we saw from the Bank of Japan. At the time they did it, we mentioned a couple of things. Like, do you want to stand in the way of the Bank of Japan intervening? Do you really think that the Widowmaker is not going to be successful? And they were largely successful. Then the other thing that we pointed out was that usually when central banks intervene in the markets unilateral, that does not last long. And sure enough, it has not. And here we are as the U.S. has continued to raise rates, as yields in the U.S. have continued to rise, largely because of the U.S. Treasury's action. I personally believe we're back towards the 150 handle on the U.S. dollar Japanese yen. And we see again today further intervention in the markets. Do you think that this one here, have they announced it? I don't believe they have announced it. I haven't heard anything, but I haven't been watching. It clearly looks like intervention from just watching the tape. That's not confirmed or anything like that. It's just at the same price it were. If it is intervention, though, do you think, you can tell by my tone, I don't think that this one is going to be successful as the last. And you can jump back over here to the last one. I think that we talk about diminishing returns. That diminishing returns comes from central bank action. There's no question about it. It's why you saw in 2008 an $850 billion bailout. It's why you saw in 2020 a $4.1 trillion, followed by $1.2 trillion for the next 2 years. Excess liquidity, no doubt. And now the Fed is doing their best to kind of bring it all home, and they're going to win. Powell is going to get what he wants. I know a lot of people have, it's like almost opposite. You come back to what was happening last year in 2022, and we're like, no, the economy is running hot, nothing's breaking. And then like in March, we're like, you know what? Why I don't think it's going to happen anytime soon. We need not to be watching out for. It looks like we are headed towards a recession. And now, as we are entering towards the final stretch of 2023, it appears why everyone else has embraced that the Fed has done it. They've engineered a soft landing, that reality is going to be kicking in soon and things are beginning to slow down. Yeah, so that's a real deal also. You see over here, there's a lot of I'm going to say fund managers that are positioned on the wrong side of this of treasury bills, and then there's a lot of speculators who are positioned on the right side. We saw at this point in time on the break of the channel, there were a lot of open interest here short the 10-year, like the record amount. And, there was a wild shakeout. So I don't know which of them were able to stay on the right side and hold. But I imagine if we look at the commitment of traders, I imagine that continues to be right. And Luke, that could go ahead and exacerbate things. At the end of the day, if something breaks, right? Well, it depends. It doesn't matter what market you're talking about. If we're looking at the 10-year here, but if it were to be something like, all of a sudden oil's trading above 120, and they're gonna start saying, well, it's the speculator's fault. If we start seeing equity markets accelerate to the downside, by the way, I meant to now take this line here, which I'm just looking here for the symmetry of this little area that we're in, and I am now moving this line over here from where that top resistance was into where we recently found support, and it's still giving the equity markets, and rightfully so, a little bit of room over here. Now it gets a little dicey because we've looked at also at that particular point in time from multiple vantage points. You could say that right below that, you have parallel channel support. And I know that we looked at it a different way as well. I'm trying to figure out how it was lined up. I don't see it right now, so I can't do it. Maybe it's right here. Right here we have the 2. So that's coming in. Yeah, I don't know. Anyway, keep it simple. So if we were to close below this line at that point in time, you know what? It's not as if we haven't seen an acceleration over here. Equity markets must be about 7-8% off the highs. NASDAQ at least 8.5%. If we were to see, we're not even close. If we were to see equity markets under pressure, they'll always blame the short sellers. They don't ever blame their policy. But Sean, I have the greatest love for all of you. There's no question about it. Euro Japanese yen, I believe, traded as high as 155. It could have been higher. Let's take a look over here and let's check it out. 156 here. Oh my goodness, I wasn't paying attention. As high as 159. So you could see traders getting jittery. I don't know. I just have this feeling that, this time, when I say this time, I'm talking about from the last time they intervened, that this time things might not go so well. It's why I highlight Luke here this morning. And listen, you should be able to consider all opinions and then form your own. I think it's a good idea to understand people's past timing, but everyone who's really, I say, committed to the markets, they're also making continued growth in their abilities, right? So I think it's important to consider all and then form your own opinions. What he's talking about here, that there's a good chance that we continue to see these yields climb higher until either we see a massive shift in the US dollar or oil. Here's the thing, though. A lower US dollar and recession could bring down the US dollar. Recession likely will bring down the US dollar. It looks like we are headed in that direction. Obviously, over the past couple of months, I've really changed my view and been setting up, we're headed towards there. But the only thing that would change my mind on that would be if we have any type of intervention in the U.S., whether or not it's from the U.S. Treasury or from the Federal Reserve, or we see a reverse in the payrolls and begin to see a strengthening in the payrolls. A lower U.S. dollar will turbocharge oil higher. Right now, you're seeing the dollar rise and oil outpacing it to the upside. A lower oil will turbocharge oil higher for a few months from now when it causes U.S. shale production to roll over. So he's saying if oil were to come down from where it is right now, let's say that we get this technical breakdown below 83, and then this begins rolling over. Don't forget, rates have accelerated. All of the shale oil is done on debt. And if we see oil come off, that production has to come offline. And when that production comes offline, it's going to stay offline for an extended, it's not easy to turn it on and off. So special SPRs run down, save your mortgage-backed securities, your only hope. Seems like a Star Wars reference or something like that. But we continue to watch over here. So I didn't give a good look over here to the euro, Japanese yen, but let's take a look over here. So here's the thing. I'm not trying to fade the yen, as the Bank of Japan is under pressure here. And to defend their curve, they need to print. What it appears may be on the table to happen in the near future is that the Bank of Japan abandons yield control curve. If that happens and we are headed towards a recession, towards a global slowdown, I want to watch the Japanese yen, maybe 2024, catching everyone off guard here as everyone is extraordinarily bearish on the Japanese yen, and rightfully so. Maybe we start seeing a massive macro shift into a strengthening yen, and as specifically, if we're heading to that slowdown, as the US dollar begins to soften, something we'll be watching, or something I am watching. I don't know how to line it up. Look at this back over here and talk about, like, this was all resistance. Those three lines were resistance. Price comes into the resistance. That broken resistance becomes support, right? Next resistance. And then watch once it gets banged away. Boom. Big move. When big moves happen in FX, specifically during global slowdowns and time of recession, we're going to watch for, it's just at this point in time, intuition. We got to figure it out. We'll figure it out in real time. This is just me introducing something to be watching for in the time of head. Right now, I would not stand away in the way of this at all. It appears that these higher yields, and if the US continues here raising, it could get much more difficult for Japan, the Bank of Japan. Right now, you could see that this is kind of getting on the table. If you remember this week, after we talking about, from August, they were moving towards a pause. It seems that November is going to stay that way. November CPI, though, should be high. What happens till December is that I think this might be on the table, either December or January. We're going to continue watching that. The other thing we're watching over here is to see when why the cut is not priced in all the way until July, September right now, to see if this begins, which I think it will, being priced in sooner into the year. I could very well be wrong on that, right? Maybe Jamin, I'm not really sure what Jamin Dimon said when he talked about rates going to 6-7%. I think he says it's possible. I don't know whether or not he feels it's probable or not. So is October under pressure right now as we continue to see a little bit of change here in, the JOLTS numbers really, we talked about this being the week of jobs numbers. John, thanks for just the support. Thanks for being here. And the biggest shout out to all of you who each and every day, it was, yesterday brought up that one of the main edges of CTM is the diversity. I never really thought about that. Flavius Frav was saying that having like-minded people who are so diverse, but when you think about it, we're all so different and bring so many different things to the table. It is really one of our greatest strengths. It's that was beautiful to look at and see. So look, regardless of what Bloomberg Intelligence says, because I I have no idea about their history being right or wrong, right? But I am just pointing out. I mean, look, I wouldn't be surprised if we broke 32,500 on Bitcoin, and then Bloomberg Intelligence is telling us we're going to have a new all-time high before the halving. I don't know, but point being is more about if we do enter a recession, if we do enter a slowdown, truthfully, likely Bitcoin will continue to be under pressure. And you all know this, someone who really has taken the time to really study Bitcoin cycle theory, Bitcoin 4-year cycle behavior, and obviously Federal Reserve policy and central banks and how they all work together, and knowing that things have lined up thus far, and just pointing out this time that this time is likely different. Bitcoin has never seen a prolonged recession. And if they allow, I don't know that they will. You all know that I'm basically just looking to be on the right side. And if any time the Fed does pivot its policy, I wish I had the chart to show you of the Bank of Japan, the Bank of China's movements in the reverse repo, because I think that's why we've seen the Bitcoin rising off of 25,000. So I think it's a. Let me just pull it up. Would you all give me 1 second? Because I could find it really quick, and then it'll give me 1 second to take a breath so we can continue on here as we get into Bitcoin. There we go. So let me just bring it up here on the big screen. It tells me it's waiting. I don't know what it's waiting for. Anyway, we'll continue on. It's weird. Sorry about that, y'all. I don't want to talk about right now whether or not what's going on here, as far as they're talking about 10,000 Bitcoin and whatnot and all that. Right over here, right? You saw this morning about 45 minutes ago, now an hour and 15 minutes ago, we were exiting this Bitcoin trade. Bitcoin taking just over 1% out of the market. Let's take over here. 1.3% out of the market, and it's on the sidelines over here. You could see, and just looking at that, price did trade below this, what was resistance, this line of going back further. An important line here, we have the chart as being one that was support, resistance, again, resistance, and then it traded below it. It's coming into it now after breaking it, but we exited that trade and continue here to hold on to, that was the exit. Sorry about that. And sorry. Continue to hold the Ethereum trade. Technically here, the Ethereum trade, Y is at break even right now. It, you could see this purple line over here. So we had the breakout, right? It's just coming in for the retest. It makes sense to be holding it, but for me, it's just more along the lines of the beautiful dance, in so much as that things started, we're looking really good. And we know that Bitcoin on the buy side is very quick to take profit. It's taking profit, being that if it's able to continue its ascent over here at any point in time, we will be entering on the upside very quickly. So it feels good, just knowing, as you saw that little taste, as you saw Bitcoin and Ethereum Sunday each move up about 4 or 5%. Just knowing when that volatility comes back into the market, that we will be there to capture it, that we will be on the right side, and more importantly, not trying to figure out what happens next. By the way, if just zooming out over here, the bull market breakout is still very much in effect. We called that starting in December, looking out for it. And then as it happened into January, this highlighted green line, as long as that holds, the bull market breakout is well underway, and likely we'll see a lot more of what we've seen in the past, right? As far as, well, I'm not going to leave it there. You all know my feelings on this. More so, though, we are in this range, which is completely no man's land. Why do I say no man's land? Because we're ranging within it. If we break down outside of it, right, then we're going to have a test with the invalidation of the bull market breakout. If that doesn't hold, we're going to have to do some strong sessions together because everything is on the table. There's no question about it. If we break to the upside, 32,500, and we've looked at multiple lines, not just the horizontal resistance, we've looked at trend line resistance as well. There's likely a big move coming towards 37.5 to 40,000. We will be there to take it. Right now, we're just going to say, have a beautiful day. Thanks for being here. And God bless you all. If you are new here, welcome. This is Jordan with Conquer Trading and Investing. It is good that you are here. I am glad that you are here. Do subscribe. Everyone else, I'll see you all on the inside. Have a beautiful day, everyone.